Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Responsible investing in Australia continues to rise with demand from institutional investors, a key driver of growth. At the same time, concerns about greenwashing within the industry have increased, but countering that is a greater commitment to transparency within portfolios. These are some of the headline findings of the Responsible Investment Benchmark Report, highlighting not just the size of the industry, but also some of the challenges ahead. Estelle Parker is the co-CEO of the Responsible Investment Association Australasia, which is a great supporter of this podcast. Estelle, welcome to Fear and Greed.
It's great to be with you, Sean.
So just how big has responsible investing become in Australia?
Look, it's basically mainstream, I would say. When you think about the breadth of responsible investment approaches, everything from integrating environmental, social and governance factors into investment decision-making right through to the real pointy end of responsible investment, we're seeing the vast majority of fund managers in Australia adopting one of those approaches. And our recent benchmark report, as you noted, shows the growth in the market. We're seeing, in particular, ESG risk considerations being really key. So 81% of managers are incorporating ESG integration into their decision making. So it's really wonderful to see year on year growing. The market itself at the moment has grown to 1.6 trillion in Australia, and in New Zealand sitting at about $207 billion. And a lot of drivers of that include things like the strengthened regulatory framework, definitely increased investor demand, but also expectations of consumers.
It's kind of how long is a piece of string sometimes with responsible investing, because how you define it, and we can talk about ESG and stuff like that, but is there a kind of, for people like myself, an easy way of understanding what does fall under responsible investing and what doesn't?
Sure. Look, there is a spectrum of responsible investment approaches, but at its core, it is factoring in considerations around society and the environment, as well as governance factors, along with financial performance in investment decision making. So as I said, considering environmental, social and governance risks. So looking at, what are the risks that the current energy transition, for example, may have on an asset, and how do you reduce that risk? Maybe by reducing reliance on fossil fuels, improving energy efficiency, and so on. But other strategies include things like screening investments by applying rules. And a very popular one, of course, is screening out fossil fuel investments from a portfolio, or even, ensuring that all companies in a portfolio have a robust net zero strategy, for example. And then there's something called thematic investing, which is where you actually proactively construct a portfolio in order to access certain benefits from trends, like a renewable energy portfolio, or even constructing a portfolio to benefit from, say, an aging population, for example. So looking at those kind of long-term mega trends. Then, as I said, impact investing is that really pointy end where you've got this really strong intention to generate really positive and measurable social and environmental impacts, but that needs to be alongside a financial return. And that's things like, social housing is a very popular one. And of course, throughout all of that, we've got something called stewardship, which is using investor rights and influence by, say, voting at AGMs or engaging in investee companies to improve performance. But that's all of that is looking at delivering a really strong financial return.
Okay, I want to take those two separately. Impact investing, how are we going in terms of growth of that? Because that has been a difficult one to stand up for many companies, though we seem to be doing better.
Well, we are doing better, and I think impact investing is still quite nascent in Australia. It's growing off a very low base. But interestingly, the institutional investors are starting to look at this. So they're standing up, within the asset owners, their own teams, looking at delivering impact, often at the kind of due to the demand of their consumers and their members. So I can't recall the exact figures, but that is something that everybody should be really cognizant of, because there are some really fantastic opportunities in the impact investing space that do deliver returns, very distinct, of course, from philanthropy. And I would also say, just on impact investing, there's some really interesting innovative partnerships with NGOs in the social housing space, in the green space, the nature and biodiversity protection space. So that is definitely an area to watch.
Stewardship, That's something which seems to have gained increasing popularity in the last couple of years, because you're not screening out stocks necessarily, but you're using your power as a shareholder to potentially influence how management is thinking. The great thing about that is that you can potentially, maybe you can never own a coal company, I'm not sure, but you can, you might be able to own some certain energy companies who are going through a transition. Just sort of explain how that works within this framework.
Look, you mentioned the energy transition, and climate change is, we're seeing 86% of investment managers, those that are using engagement and voting as an investment strategy. Climate change is the issue that they are all looking at, but also things like diversity, looking at the gender balance and so on boards, and issues like human rights. And that's modern slavery, that's looking at Indigenous cultural heritage protection, and then as well as that, general kind of environmental concerns and ensuring that biodiversity and nature are protected. And that is, everything, as you say, from voting at AGMs, using the influence that they have, but also having meetings, engaging with companies. And that is becoming much more robust, I would say. So it's no longer good enough to say, as an investor, I've just sent, a bunch of letters to a bunch of companies that we're invested in to tell them that they should have better diversity on their board, or that they should have a good net zero strategy. But they're actually following up, and they're reporting to their members and consumers as well on the kinds of activities. And we're seeing a lot more transparency as well in voting practices.
Estelle, I still want to talk to you about greenwashing, green hushing, a few other challenges for responsible investing. We'll do that after this break. I'm talking to Estelle Parker, co-CEO of the Responsible Investment Association Australasia. The report talks about greenwashing or green hushing. Can you define those, and just how big a challenge is it for the industry?
Sure. Look, greenwashing itself is essentially overstating the environmental or social benefits of an investment. And as we know, the regulators really have been cracking down over the past couple of years. And this is a good thing, because we want the claims that are being made out there to consumers, where there is a huge demand for investments that are responsible and that also have positive impact. But consumers themselves are telling us that they are concerned about greenwashing in the sector. They're also telling us through our consumer surveys that they are much more likely to invest in a product that has been verified by a third party. So RIA itself, we run a responsible investment certification program where we really comb through those products and make sure that they are what they say they are on the label. It's not much different to a tin something on the supermarket shelf, tin of baked beans. You expect what's in the tin to reflect the same as what's on the label. And so the industry has responded to the regulator signalling. We're seeing a very strong pipeline of products coming to us for responsible investment certification. And I think as well, you're right, green hushing is a bit of an issue. And we have seen some funds pulling back a little bit from claims that they are making in order to ensure that what they are saying accurately reflects exactly what they are doing. So you really do need to substantiate claims.
Okay. There's been a number of high-profile cases of alleged greenwashing. I bet that's not necessarily a bad thing, because it actually puts everyone else on notice.
Look, I know when ASIC put out their first guidance a couple of years ago on greenwashing, which was essentially clarifying, it's not like a whole lot of new greenwashing legislation came up. It was clarifying existing consumer law and the expectation of investors under that consumer law. And we do know that funds kind of went away and had a really good look at what was in the marketing material compared to what was in their legal documents, and then comparing that to their portfolio holdings. And so I think the industry now definitely understands that it's no good just to make claims and not doing anything about them. You really need to back up those claims with robust strategies and practices. And you also need to be really transparent about that.
The report focuses on where we've been. It is a new world from January 6th, and Donald Trump's administration obviously has made lots of noises around some of these issues. Do you think in Australia it will matter?
Look, good investors think long term, right? So as we've just been talking about, consumer awareness and demand for this stuff is growing. Responsible investors understand that you need to think long term, and that good responsible investment, including ESG integration, but also thinking about longer term trends and trying to access those opportunities, makes really good business sense. So the political environment obviously has been raised by some. We see geopolitical risk. We see performance concerns across the board all the time. People are considering this stuff. But good investors think long-term. Performance is very, very good. It has been very good for the products that RIA certifies over quite a number of time periods and over quite a number of years. We see certified funds perform on par with or better than the rest of the market. And the most recent data shows that they are outperforming on 1 year, 5 year and 10 year periods, which results do vary quite widely by asset classes. We're also seeing globally, Morningstar Direct has basically said that over the past decade to 2025, the top 20 sustainable funds globally have garnered a really positive average return of over 13.5%. So, smart people are looking at this. They're thinking much longer term than a 4-year presidency, and that obviously allows them to consider, where we're going globally and filter out the noise.
Estelle, thank you for talking to Fear and Greed.
It's been a great pleasure, Sean.
That was Estelle Parker, co-CEO of the Responsible Investment Association Australasia, which is a great supporter of this podcast. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before investing. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.